We come now to the third foundation element of corporate finance. Whenever you build a financial model for any structured finance purpose, whether it's project finance, leverage finance, looking at restructurings, divestments, and so on, the most important line in your model is the one that says free cash flow. There are 4 reasons that free cash flow is the most important line in your model. But before we go and look at those 4 reasons, let's first of all, by way of definition, identify what free cash flow is. There are 3 types of cash flow in this world: operating cash flows, investing cash flows, and financing cash flows. Free cash flow is the first 2 of these. In other words, it is operating cash flow minus capital expenditures and plus or minus the movement in working investment. Now, I've done capital expenditure. Capital expenditure is obviously the investment into the infrastructure of your business, and working investment is the movement in net trading assets, not net current assets. Because what we're trying to achieve with this concept of free cash flow is not only to make sure it is a cash flow, but an absolutely surgical separation between the financing cash flows on the one hand and the operating and investment cash flows on the other. So surgical is this separation that a better way of explaining free cash flow is that it's all of the stuff that is left over to throw at your financing structure, because anything that is not to do with financing is in the free cash flow number. If it's to do with financing, then it's below the line, it's not in the free cash flow. And the problem with current assets and current liabilities is that they have embedded in them financial items. Current liabilities has short-term debt, dividends payable, and so on. What working investment is not net current assets, but net trading assets. If you're ever confused about whether to include an item in the calculation of free cash flow or not, ask this question: does this item relate to the trading of the business or to the financing of the business? And then it's pretty obvious of whether it should be in or out. If it's prepayments, warranty claims, and so on, these relate to trading. If it's dividends and interest payments, these relate to financing. Okay, so this is the definition of free cash flow. Why is it so important, and why are we here to pay attention to it? Well, the first reason that free cash flow is critical is essentially cash management. I just said that free cash flow is all of the stuff left over to throw at your financing structure. So let's look in the first instance at a limited recourse financing. Let's imagine that you only have one cash flow. You've built a power plant, there's only one cash flow generated by that single piece of industrial infrastructure. So this black line on the diagram is the only cash flow that you have to support your debt serviceability. So if I was to draw on this diagram the red line, which is the financial commitments, it would, as of necessity, have to sit underneath the black line. But there you see in year 6 in my diagram, the cash goes seriously negative because the free cash flow goes to 0 or thereabouts, and certainly doesn't cover the financial commitments. And so what we have to do is identify risk or volatility. Well, we have just done so. We then have to quantify it. Well, this model has quantified it. How deeply negative are we going, and for how long? And then step number 3 is how are you going to manage that volatility? Maybe in year 6 there will be deferred equity contributions. Maybe there will be drawdown or standby financing arrangements. Or probably more likely, in the first 5 years of this transaction, instead of distributing all of the surplus cash flows, we will set aside or accumulate by way of reserve an amount of money that will meet the requirements that we've identified and quantified in year 6. I mean, how you solve it will depend on the facts of the individual case. So you see that the first reason that the free cash flow is critical in a limited recourse financing is cash management, debt serviceability, and so on. Let's imagine that we are the treasurer of a normal company, not a limited recourse financing. I'm still vitally interested in free cash flow because once again, here's the diagram, the cash flow, the free cash flow driving forward. The better a company we are, the more attractive our prospects. It's one of the paradoxes of business. Our profits go up and our cash flows go down. And we become permanently negative cash flow. And the reason for this is that we're growing so fast, we have such attractive growth opportunities, that we are investing more money than we are currently generating from our operations. Let's imagine that our company has a business strategy that over the next 10 years, we need to mobilize $800 million to finance our growth potential. I now need, if that's the business strategy, I need a financing strategy that identifies where will that $800 million be coming from, what products, from what markets, in what sequence. Because if I don't plan it, if I make it up as I go along, then the financing that I do this year is likely to get into the way of the financing that I would like to do next year. And because we're disorganized and muddled, we'll only end up raising $500 million over the next 10 years, which means that our business strategy will be curtailed simply because we didn't identify the free cash flow that was going to be available to drive that $800 million that we were seeking. So whether it's limited recourse or whether it's just normal corporate, again, it's financial cash and financial management is critical. By the way, these rapidly growing companies, they're very exciting, but also very dangerous. Because your negative cash flow, year after year, your company is being propelled into the air by the rocket fuel of debt and equity markets. And should those debt and equity markets ever lose confidence in these investments, or that you're the wrong people to be handling those investments, then your company has the gliding capacity of a brick and you drop out of the sky vertically. If, on the other hand, you're a big, fat, boring company and you make horrible mistakes, you can glide for years and years and years. When Chrysler, at the time of the quadrupling of oil prices in 1973, they had no medium-sized or compact cars. They only had those gull-winged Buicks. When IBM didn't see desktop computers coming in the beginning of the 1980s, they always thought it was going to be mainframes occupying whole floors of buildings with air conditioning systems. When Apple was on the verge of bankruptcy under Gil Amelio 19 years ago, at the beginning of the century, plenty of time for Lee Iacocca to come and turn around Chrysler, for Lou Gerstner to come and turn around IBM, and for Jonathan Ives and Steve Jobs to return to Apple. If you're in a jumbo jet and you're at 40,000 feet and you lose all 4 engines, you have precisely 36 minutes before you hit the ground. Plenty of time to resolve the issues, or indeed to find the parachute. That brings us now to the second reason that the free cash flow is so critically important. But this one really only applies to limited recourse financings. The financial covenants in a project financing or a limited recourse financing are the financial covenants you'll find in a loan agreement are totally different to the financial covenants you'll find in an ordinary corporate loan agreement. And to explain the reason why, if I'm lending to a company, a normal company, the company has indefinite life. And if I'm a good cash flow lender, I never expect the company to repay its debt. The individual loan will have a maturity date, of course, but conceptually, the source of repayment is refinancing. Because as a company gets bigger and bigger, its cash flow gets bigger and bigger, and I would reasonably expect a company's debt to get bigger in proportion to the cash flow there is to support it. And therefore, in financial covenants for a corporate loan agreement, we never look at the ability of the company to repay debt, but at the ability of the company to sustain a level of debt. So the dominant covenant will almost certainly be interest cover. Either earnings cover of interest or cash flow cover of interest, I don't care much which. And the other dominant covenant will be gearing or leverage, the relativity of debt to shareholders' equity. Now that makes perfect sense when you're lending to a company. But financial covenants in a project finance loan agreement, what I've just explained, will not at all do. Because the borrower, the special purpose vehicle, has a finite life. The cash flow will come to an end. There are 4 things that will bring a project's cash flow to an end. If it's a concession-based project, at the end of, let's say, 30 years, if that's the concession term, there will be no cash flow. If I have let's say, a 25-year offtake agreement or a power purchase agreement, there may be life after year 25, but I won't know until I get there. My project could be obsolete in 25 years' time. Come and see me in year 24 and let's discuss. In the meantime, I would want all my money back. Not just the interest, I want principal and fees as well. The third thing that can bring the cash flow's life to an end is the life of the underlying equipment, the equipment itself. And fourthly, in extractive industries, when it costs you more to get it out of the ground than what you can sell it for. In other words, commercial parameters will dictate the ending of the project's cash flow. And if I'm lending to such a special purpose vehicle, I want 2 covers. I want amount cover and I want time cover. I want to make sure that I've got plenty of cash flow to fully repay the debt as well as service it. And I want time cover. If it's a 30-year project, I don't want my last payment coming over the line on December the 31st of the 30th year. I want tail. Daylight between the end of the project's, between the end of the loan's life and the end of the project's life. Amount cover and time cover. A banker asks the question, do I get out in time? And the only way we can answer this is not by looking at last year's audited financial statements, which is what you base I should have said, in the financial covenants in a corporate loan agreement, the interest cover is not based on the future projections, it's based on last year's audited financial statements. To know in a project financing whether I get out in time, I will learn nothing about that by looking over my shoulder at accountancy or the past. So we look instead forwards at the projected cash flow, the project cash flow model. And the financial covenants in project finance, loan life cover ratio and debt service cover ratio, are both forward-looking and cash flow based. That means the project cash flow model will, as of necessity, be audited. There are people, would you believe, in Deloitte and Touche, PricewaterhouseCoopers and so on, who are full-time model auditors. All they do all day, every day, is look at other people's models. These people must be wows at dinner parties, but such people do exist. Now, the third reason that free cash flow is critically important is whenever you want to arrive at a valuation of something, value a company, value an asset, value any opportunity, the thing that we value is the free cash flow, not, incidentally, the operating cash flow. And the reason that we don't use the operating cash flow, look in the diagram, what's going on in year 6? Am I simulating a recession or something like this? Well, almost certainly not. I am fairly sure that in year 6 we have a major item of capital expenditure. Remember, the big item we deduct in arriving at free cash flow is capital expenditure. Maybe it's a phase 2 expansion, some refurbishment. Some industries, by the way, are famous for very lumpy capital expenditure. Pulp and paper is probably the most extreme example. 12 years of no capital expenditure, and then in the 13th year you have $1.5 billion to spend all at once. Brewing is the same on a 10-year cycle. A baseload power plant, every 6, maybe 7 years, you have a Part C refurbishment, and it looks like this. A hotel, every 6 or 7 years, or every 5 or 6 years if you're near the sea, you have a refurbishment. You don't do it, but each year, bang. But do you see how the cash flow takes off in the subsequent period? I am fairly sure that the takeoff in the cash flow beyond year 6 is related to the investments that are being made here in year 6. And in evaluation, you can't conveniently value the good news without bringing into the valuation the bad news, i.e. the negative cash flow that was necessary to achieve it. You can't have it both ways. You can't have it your cake and eat it. You have to bring them both into the valuation equation. Now, just to pause here for a moment. If you're a finance director of a publicly listed company in the modern age, you unfortunately have to ride 2 horses at the same time when making decisions. And these 2 horses don't usually run in the same direction. Horse number 1 is every decision we make, the value of the decision should be greater than its cost. Yeah, we already know that from what we've discussed before. But unfortunately, in addition, share markets go through cycles of fashion. In the 1960s and the 1980s, share markets rewarded diversification. All the highly rated companies were busy diversifying. In the early 1990s, the fashion of share markets around the world was core focus. Now, core focus is the precise opposite of diversification. So all those companies that were busy diversifying in the 1980s were suddenly having car-boot sales of all their disassociated businesses to meet the share market fashion. From the late 1990s to the present, the dominant fashion in share markets around the world is growth, and specifically earnings per share growth. Now, it astonishes me that we are here in 20-odd years into the new century, and we are still looking at earnings per share growth as the dominant financial metric in international share markets. When I transitioned from law into banking many years ago, at 9 o'clock on Monday morning of my first day in finance, I attended a lecture. The very first thing I learned in finance, the title of the lecture was Earnings Per Share Don't Count. And I'll make that lecture available to you because I have it in text. And so, as I said, it's the very first thing I ever learned. Earnings per share is not for, if you look at earnings per share, then you are ignoring that capital. You're only looking at earnings. You're not looking at the investment that was necessary to create. Anybody can grow. I can double my profit by trebling my investment. But what the heck is the point of that? And secondly, valuation is in the future. If you're looking at this year's earnings versus last year's earnings per share growth based on audited financial statements, which is what the current market fashion is, if you're not looking at the future, but you're looking at this year versus last year, you're looking at the wrong thing. You're not looking at the future, and you're not looking at cash flows. You're looking at accountancy, and you're looking at present versus past. Now, I would love to ignore share markets, but if you're a finance director, you can't afford to, because your share price will tank if you don't pay attention. And therefore, you implement transactions because the value is greater than its cost. But when you actually put those transactions, when you implement them, when you put them into practice, you have to be very careful to structure the transaction so it is not earnings dilutive. And if possible, ensure that it's earnings accretive. I'll discuss that more later on. The fourth reason why free cash flow is critically important, the investment rule. Whenever you make an investment, always break the investment decision into two steps. Step number one, do I want to do the deal or not? Yes or no? And for this step, you only look at the operating and the investment cash flows. If your decision is yes, I would now like to do this deal, only then go on to step number two, which is how should I choose to finance it of the various choices that might be available to me. Now, it's not that step number two is less important, it may or may not be. The point is it's a separate step, and don't allow the two steps to become merged. Now, in the accompanying notes to this video, I'll just run you through the little brain teaser or the little example that I gave. Let's imagine on this slide, who are you? You're the business development executive at a company. It's your job to make recommendations to the board between different opportunities. And in our limited classroom environment, there were only two opportunities, A and B. Now, don't make differences between these two. Except what appears on this diagram, they are exactly the same as each other. Both opportunities are of the same size, they have the same risk profile, the same strategic implications, the same human resource skills required, and so on. The only difference is that in deal A, the return on capital is, let's say, 9%. And the cost of the financing is 6%. So there you are. That's the situation for deal A. Now let's go across to deal B. By the way, the after-tax cost of 6% is because we're doing 100% debt financing. That's what we've decided to do. Deal B, we're going to finance it with 100% equity. And the required return on the equity is 15%. And the return on capital, as you can see, is 12%. So, if all other things are equal, which they never are in real life, but they are in a classroom, which of these two transactions will command your superior recommendation? Now, unfortunately, we haven't got any interaction going here. There's a good chance you may have said A. Well, you had a 50% chance of getting it right. It should take 1 nanosecond to answer this question. Quite definitively, if all other things are equal, then deal B is superior to deal A. Now, before we go and look at the funding, which is a completely separate and different question, let me just draw your attention to something for a brief moment. You see, I have return on capital. I think some minutes ago, I explained that free cash flow was operating minus investment cash flow. It's a subtractive equation. And free cash flow is a monetary number, dollars and cents. Return on capital is operating divided by investment cash flows, a divisional fraction expressed as a percentage. But the ingredients are the same, and therefore return on capital are different and free cash flow are different expressions of the same thing. The ingredients are the same, they're mixed differently, but they are substitutable. They are step one investment decision making. I said again a few minutes ago that whenever you do a valuation, you always base the valuation on the free cash flow, not the operating cash flow. In other words, if I wanted to calculate the IRR, the internal rate of return, I do it directly on the line in the model that says free cash flow. In other words, the IRR is the same as the free cash flow. It's a different expression of. It's also a percentage, just like the return on capital, but instead of one element expressed as a percentage of another element in a divisional fraction, IRR is an iterative calculation, about which I have much more to say in another video. The correct calculation of an IRR is the worst taught area in the whole of finance. I see so many models where the IRR is incorrectly calculated, but let's save that for another time. If I box all of these three together, they are all step one investment decision making. And I wanted you to cotton on to this because in a subsequent video I want to start putting formulas on the board or on a slide and then substitute one for the other. And of course, you know in mathematics you can't substitute one thing for another unless they're equivalent. Well, I'm explaining the equivalence now. Now let's turn our attention to the financing decision. How I choose to finance something is a completely separate consideration. I might decide to finance something with equity because I think equity markets, let's say, are stupidly overpriced and you don't meet enough fools in your life to miss the opportunity of taking advantage of a fool. On the other hand, I might decide to finance it with debt because I had an equity raising only last month. To have another equity raising now would not be pragmatic, it would not be opportune. There's all sorts of reasons why you might decide to finance something this way or that way, but nearly always your financing decision is pragmatic. Please don't hypothecate the financing decision to the investment decision. Don't do this. Don't go +3 -3. Because if you link them in this way, by the way, if you have already done some corporate finance and know about things like cost of capital as well as return on capital, by all means link it to cost of capital. But this financing cost is not the cost of capital of the company, it's the marginal financing cost of the investment, which means it's fundamentally different. Please understand the next two sentences. This financing doesn't belong to the investment. This financing belongs to the company that's making the investment. And if you, sorry, I had a fly. If you kept doing 100% debt financing, 100%, 100%, 100%, the company that is borrowing this money has a finite capacity for debt. At some point, it can't raise any more debt, and for any marginal investment that it must make, it must raise equity. And if you link that investment to its marginal financing cost, even though it is superior, you choose not to do it. One of the biggest errors in investment decision making. Please don't fall into this trap. You're probably familiar with the old saying, for every rule there's always an exception. And to this investment rule there are two exceptions. Exception number one, you do link the financing decision to the investment decision if they are linked as a matter of fact. So let me give you an example. Let's imagine that we're building a plant and we're using German imported equipment, and Hermes, the German export credit agency, is offering financing terms that actually aren't very attractive, even though the equipment is. Far more attractive is the French export financing. But unfortunately, the French equipment in my project would not deliver such a favourable operational result. So clearly what I want is the German equipment, but the French export financing, well, I'm afraid it doesn't work like that. Either you want the German equipment, which means you have to put up with the less attractive German financing, or you want the more attractive French financing, but will have to make do with the French equipment in your transaction. In other words, it's a package deal. We either go French or German, and on our model we have a toggle switch, which gives us the higher IRR, the German or the French solution. But remember, this is an exception to the rule. 99 cases out of 100, I have a genuine choice of how I'm going to finance something. It is only in a small minority of cases that the financing is packaged to the investment, and I have to go. And if they're packaged together, as a matter of fact, then they have to be packaged together in your analysis. The second exception to the investment rule is where between you, the decision maker, and the underlying transaction that you're analysing, you interpose a special purpose vehicle. And the financing is not your company's. The financing is the special purpose vehicles with limited recourse to you. In other words, limited recourse financing is the second exception to the investment rule. And much later in the programme, we'll go through how the analysis changes when you're going to have financing through a special purpose vehicle with limited recourse. Save for those two exceptions, always remember to separate the financing decision from the investment decision.